Basically, if it goes up at such a fast rate and reaches a surprisingly high price faster than I think, I could potentially sell into that if it becomes very euphoric. Um, with the ideal that it's, for risk management, I might be able to buy more coins with the same amount of money later.
Mm.
Um, and so I'm not, trying to time the market exactly, but if I do see a lot of euphoria, I would consider it. And so, for example, earlier this spring, when we started to see pretty much every coin was going vertical, right? So Dogecoin was going vertical, Ethereum Classic was going vertical. I warn my subscribers, like, this is no longer a particularly healthy looking market. And so I didn't sell, but I was making sure they were aware of the risks. And so we eventually got that correction. Now, if we were to see an even bigger, euphoric move, say next year, I would consider potentially trimming a little bit off the top. And that's more about risk management, making sure your allocation doesn't become too large of your portfolio, rather than trying to time the market precisely. I would essentially bring that back to fiat, but it depends on what the stablecoin environment's like at that time. And so, for example, if you can get reasonable yields on your stablecoin without taking too much risk, I think that's a reasonable type of diversification. In different parts of the world, we're seeing some more regulation pressure on some of these stable coins. And so I would certainly stick to the higher quality stable coins. And I wouldn't take on too much risk for that. But yeah, there's, especially if I expected a multi-year correction, I would consider pulling that back out in fiat and going elsewhere. But again, that's only for a portion of my portfolio, and only if it reaches very euphoric levels that look like they're unsustainable for a multi-year period. Another thing I would point out is that I think, the halving cycle should become less important over time, because and it used to be that the mining supply of Bitcoin was a very large percentage of the existing supply. But as we've gone through a few halvings, that's now a very small percentage. It's a low inflation rate, in other words. And then we're actually starting to see an interesting dynamic now that miners have largely moved out of China and towards North America and other countries in the world. We've seen basically a change in how miners treat Bitcoin. And partially that's because the financial industry's kind of caught up a little bit. And so now there are specialized lenders. And so the cost of capital for mining is lower. They can get lower cost financing. So if you were trying to mine in China, for example, it's really hard to do it, right? You were kind of, you had uncertain regulations. There are not a lot of lenders that were specialized in lending to you, so they would give you very high rates, for example. But now that they've moved into North America, and some of them are public companies, publicly traded companies, they can access very cheap sources of capital. And so actually what we're seeing is that a number of the large miners that collectively probably own 20 or 30% of the hash rate over the next year are using a strategy where they just buy Bitcoin and hold it on their balance sheet. Like, they mine Bitcoin, and hold it on their balance sheet. Some of them have actually also just bought additional Bitcoin to hold it. And so rather than mining it and then selling it to other buyers, that new supply just gets locked up in the miners. And so that actually potentially reduces the importance of the halving, because that's just Bitcoin that's kind of getting stuck on miner balance sheets. So that kind of comes down to what percentage of the mining industry is going to adopt that or not. The challenge that I see is I actually view this period between now and whenever Ethereum 2.0 is launched to actually be the bullish part for Ethereum, because they've kind of created a supply shortage. And so the way that works is, right now they rolled out the Ethereum 2 beacon chain, which means that it's essentially a smart contract that people can put their ETH to and start staking it, but they can't withdraw that ETH stuck in there until they do the Ethereum 2.0 transition. So that's basically a supply sink. It's turning liquid supply into illiquid supply at the same time as they introduce that EIP 1559 change, which results in less supply or potentially even a slow destruction of existing supply. And so that combination is actually pretty bullish for price over, say, the next 6 to 9 months. But then ironically, it could be like a sell the news event, because, buy the rumors, sell the news, because when they actually launch Ethereum 2.0, all those liquid coins would be able to be sold. And so we don't know how that's going to affect the market. And so I have long-term concerns or questions about Ethereum, because I don't view it as decentralized or rock solid secure as Bitcoin. is trying to solve more problems and be more things. And so I view Ethereum more like an equity where I'm analyzing, say, the main developers, I'm analyzing their business plan, and I'm kind of viewing it like that. And more broadly, proof of stake actually has a lot of equity-like components, right? So when we think of shares or a company, you get voting rights based on your ownership stake of the company, which is how it's essentially a proof of stake model. And so, tokens that go in that route, I view more as like an equity. So Ethereum's kind of like a partially decentralized operating system, like Microsoft, for example. And so I treat it like that, which is somewhat different than how I treat Bitcoin, which is as money. So it's a more kind of rock solid decentralization, and it's more simple by design, and that has pros and cons. Potentially, yes. And so, I mean, first I would take a step back and I would say that storing value and transmitting value that no one can block is already extremely valuable. So if it only ever does that, that's already a multi-trillion-dollar long-term opportunity. And so, for example, if you look at gold, but based on estimates for how much exists in the world, already mined, multiplied by its price, the estimated market capitalization is somewhere around $12 trillion. And that's purely as a store of value at this point. It's not really good for medium of exchange. Whereas Bitcoin has store of value properties, but then also has, certain medium of exchange properties, right? So you don't want to use it on the base layer to buy coffee, but you can do that with a secondary layer. And it's ideal for international payments, permissionless payments. And so it's already, potentially a larger addressable market than gold. Then when you add things like, for example, on the Lightning Network, you can have, we're seeing Impervious AI. That's a company that is actually using the fact that, Bitcoin doesn't just transfer value, it can transfer data. And so you can make a distributed VPN, basically, decentralized video sharing, data sharing. And so that's actually some neat applications of Bitcoin. And we also see Sphinx Chat, for example, which is a social network built on top of Lightning. And so those types of applications could provide additional value. We've also seen some DeFi protocols launch on Bitcoin, right? So obviously they came later than on Ethereum. They don't have large network effects and liquidity yet. But it remains to be seen how they'll develop. So I would say that already the addressable market of Bitcoin is large, and then we have some of these other options